This is Tim Phillips, Chief Investment Officer at Phillips and Company Advisors, and I'd like to thank you for tuning in to our Q2 2024 look ahead. Please read all the disclosures carefully. Between the work and wages and wealth creation, the consumer is in amazing shape. Wages have outstripped inflation for 10 months now, and the private sector is adding, on average, 200,000 jobs per month. That's just enough to absorb new entrants and not too much to spike inflation. On the upper right, you can see wealth creation has been supercharged across most cohorts. And if the consumer did run into a little economic trouble, there's plenty of borrowing capacity as household debt service is still relatively low. The consumer looks strong. Yet the consumer is still miserable. According to a recent misery index, which measures the 4-year change in consumer prices and unemployment, the US consumer is simply not feeling it. As measured by Goldman Sachs, the consumer is frustrated with high prices, even though inflation is moderating. You see, the consumer wants prices to drop, and that's not what's happening. And while wages have outstripped inflation over the last 10 months, and you can see that in the upper right-hand corner, the consumer spent over 2 years losing purchasing power. That's simply going to take some time to overcome. And if history is any guide from the 1980s, it could take about 2.5 years. Misery might be the Achilles heel to the political class in America as well as the economy. To that last point, there are some economic early warning signs. Savings is down and credit card delinquencies are on the rise. Bankruptcies are also on the rise, driven by higher interest rates, and the number of people taking emergency 401k withdrawals is at a 6-year high. That's not to mention anything about the commercial real estate market with significant loan delinquencies. These are clearly early warning signs the Fed needs to pay attention to in the macroeconomic picture. Putting all that negativity aside, none of those micro trends are being reflected in consumption and U.S. corporate earnings. Earnings per share growth is rebounding off a very low base in 2023. And in fact, full year 2024 earnings per share growth is estimated to come in at around 13%. That's pretty strong. Now, while valuations are stretched, profit margins are expanding. With inflationary pressures easing and pricing remaining sticky, companies will reap the benefits of wider margins and more profits. Now, the truth about valuation is this. When you strip out the tech sector, you can see a host of fairly valued stocks within the S&P 500. And perhaps it's those companies that can be drivers for the next possible leg up in equity returns. Interest rates and inflation, it's been a bumpy road. The Fed has maintained their target for 3 rate cuts by year end. While street expectations started the year at 6 cuts, it's now much more in line with the Fed at 3 cuts. That's that green shaded area. Concurrently, expectations are for higher rates for longer on the street, and that's that purple line, with the Fed expecting more cuts to occur in 2025. That's that blue shaded area between street expectations and the Fed for 2025. The Fed's also adjusted, albeit slightly, their inflation expectations, and much of this is driven by the stickiness in shelter inflation, which makes up almost 40% of the index. It's a flawed survey, in my opinion, that to ask homeowners, actual homeowners, what they would charge as rent. If you stripped that flawed survey out, you would see a much more benign inflation picture. That's in the lower right. That's much closer to Fed, in fact, it's below Fed targets. This could be the anatomy of a Fed policy error in the making. Let's hope the Fed recognizes the flaw in their survey and adjusts accordingly. Regardless of how bumpy the inflation road is, the Fed's signaling they're prepared to cut interest rates into an expanding economy. The Fed's policy setting committee is supporting and suggesting that they expect real GDP growth to expand from 1.4% to 2.1%. They've actually lowered their unemployment rate expectations and raised their core inflation expectations. And you can see that in the table in the upper left. Yet when asked if those expectations might mean a pause in interest rate cuts, the Fed chair said no. They continue to expect to cut rates 3 times this year. He went on to suggest that that's because the supply side of our economy can meet the demand side. With GDP expanding at 2+%, supply should in fact meet demand. However, historically inflation has only cooled when the unemployment rate spiked higher. So is this time different? Can the Fed actually cut rates when record low unemployment is in front of us? That really is the trillion-dollar question. There are really 3 main points to consider in looking forward on fixed income. 1, global central banks are all preparing to cut rates throughout 2024, and Japan is prepared to finally end 17 years of negative interest rates by raising rates. 2, as rates get cut, more dollars will flee money markets and perhaps chase longer duration fixed income and equities. And 3, we believe the Fed's final landing spot for short-term interest rates will be in the 4% range, mostly driven by much higher productivity and perhaps a little higher inflation rate than the 2% target. Either way, with rate cuts, longer duration fixed income should rally nicely, and you can see those returns in the lower right-hand corner on this table. Like U.S. equities, developed market equities are poised to post stronger earnings per share growth throughout 2024. Couple that with modest valuations, and there could be opportunities to increase weightings in developed markets. We caution against being overly enthusiastic as GDP growth, while positive, still looks anemic throughout the developed markets. Moving to emerging markets, the same earning growth trends hold true as the U.S. and developed markets. Only earnings per share growth for full year 2024 are expected to be in the 17% range. That's incredibly strong. With valuations at 43% discount to the U.S., it's hard not to continue to tilt to emerging markets, especially when you consider the second largest economy in the world. China offers the least crowded investment across the globe. Our mean reversion dashboard should give you a good global view of what's cheap and what's expensive across a host of asset classes and countries. Of course, relative to their 20-year average, everything in the U.S. is quite expensive. Looking across other areas, emerging markets offers great opportunities as well as frontier markets, China being the cheapest and Brazil not too far behind. You can see our views and recommendations on this page, primarily still highly dependent upon what the Fed does. We think the Fed holds their pause for much of this quarter, and we also think the consumer taps the brakes on their aggressive consumption. However, later in the quarter, we do think the Fed will commence their cutting cycle. For us, that means emerging markets and developed markets may offer some opportunities to the upside. And of course, with the aggressive run-up in U.S. tech, we're looking at shifting some dollars from large cap growth to core. Needless to say, with those rate cuts, we want to continue to extend duration in fixed income. On behalf of all of us at Phillips & Company Advisors, I'd like to thank you again for taking the time to tune in our Q2 2024 look ahead. Of course, you can email me at the email below, and of course, reach out to your advisor with any questions, thoughts, or feedback.